Good morning, everybody. It is the Friday before Labor Day weekend, September 4th, 2020, a few minutes after 10 a.m. Central Time in the heartland of America, where the corn is growing pretty mediocrely right now, but it tastes good. So we're going to review the same presentation that we talked about last week, but very quickly, and interject some thoughts about the employment situation. As I've talked about for 2 years, when the employment situation gets bad, that's when we have to be very concerned about our stock market investments. And why is that? Well, the main reason is that people who are unemployed stop investing in their 401ks, and that is a major inflow into the stock market. Now, with as serious of a situation as we have now with COVID causing massive unemployment, and I will talk about some of the numbers that came out today, which I think are fuzzy math, to say the least, we should consider as investors how we want to get to the spots that we want to get to. How do we want to make our money in investments? Do we think that we're superstar traders skimming the system? Or do we think that we're investors helping to build the system? Abraham Lincoln had this to say, and I think it's fairly obvious, to me anyway, of the two candidates running, which one believes this more. You decide. Today, stocks are losing again. This is something that I've been talking about, likely to happen. Interestingly, certain parts of the stock market are falling a lot more than other parts of the stock market. We have the S&P 500 down about 2.5%, and Nasdaq giving up almost 4%. It was down a little bit more earlier today. I would suggest that if anything else, this should help you understand the fragile nature of this market. I have talked about the underlying supports for the market. I have talked about why there isn't an underlying bid beyond the Fed, and that the Fed was running into diminishing marginal returns on their bid by providing liquidity into a market. We've taken a look at how the younger investors have piled in the call options and leverage on the Nasdaq 100 in particular, but also other technology stocks. And we have taken a look at all sorts of charts that tell you that the smart money has been pulling money out of the stock market and starting to bet against it, and that the dumb money, the small retail investor, has been just betting on things going up and up and up and up and up. Now, something that I want you to remember from a very, 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 very long time ago in a galaxy and stock market far, far away, was that there are mornings when you can wake up and the market is limit down. There are mornings when you're going to look at the stock market, and we just measure by the Dow Jones Industrial Average because that's a clever, easy way of doing it, of being down 2,000 points in 20 minutes. I am telling you that's going to happen again. Now, I don't know when. However, I have said between now and the end of the year that is when we should expect another shakeout in the stock market. How far down does it go? Well, it's hard to know, but traditionally, the stock market would give up about half of the gains from bottom to top. So here we see that the stock market, measured by the S&P 500, got up to about 370, was it? Right around there. And the low was at about 210. So that's 160 points. You'd expect about an 80-point drop to right around this range right here. And this looks like structural support. So a little under 300 on the S&P 500. But wait, there's more. We also know that this is extremely overvalued, but this is still overvalued. And this level here, about here, and just above this area here, and you got to remember 4 years of time, This area in here actually happens to represent roughly fair value on the stock market based on historical norms. Now, that doesn't take into account any adjustment for super low interest rates, and I don't really know how much that adjustment should be. However, one would think you take the interest rate that's historical versus the interest rate that you see now, make some adjustment for savers, putting a couple of bucks into dividend stocks and some corporate bonds, and you would think that somewhere between this level here and this level here is where the stock market's going to get to in the not too distant future. So from about here to here is what we should expect to see soon. So I don't think anybody should start buying until we get to at least this area here. And I know that's a question people have. Should I start buying? Should I get rid of my short positions? I'm not. I'm not getting rid of my short positions. And in fact, I'm holding pretty tight. And I think that until the S&P 500 gets down to around 3,000 again, I'm very unlikely to get rid of any of my short positions. Why? Because if there's not a good fiscal deal here in the next couple of weeks, and the layoffs that I'm going to show you in a moment actually occur, and it certainly seems like they're going to, we are going to get the mother of all recorrections, and that Armageddon scenario could actually play out after the election. So I think it's incumbent on you to be very, very cautious with any money that you think you might need in the next several years. And I think you ought to review what I said late last year, which is that the 2020s could end up looking a lot like the 2000s, where the stock market started here, crashed, got to here, crashed, and let's just round up a couple of years. In this 14 to 15 year period, right, and this is the S&P 500, not Nasdaq, round tripped. So from spring, late winter, spring of 2000, all the way out to about 2013, so about 13 years. The stock market didn't really make any money, got interest. And we can go back and look from the middle 60s to the late 70s that it happened then too. So it's not uncommon for the stock market to go a decade and not really make any money. And I think that people have to wrap their heads around that, because from here to here, we already knew in this box, which we got the choppiness for 2 years, that the stock market was pretty much fairly valued. And then we got massive tax breaks and cheap oil and deregulation. And then we got massive, the biggest monetary stimulus in the history of the universe from here to here. Where these two lines meet is roughly fair value. So the idea that we can't get back down to here is significantly misguided. I don't know that that's what will happen, but to dismiss the risk, which a lot of people have done, is foolish. I've had 6 people fire me in the last, I'd say, 2 months because I didn't get it, because I missed it. We'll see. Does anybody really believe that this just can't keep going down? If you believe that, stop listening now and move on, because it can happen. As an investor, we have to be aware that when valuations, which should be right around here, based on history, with a small adjustment up for low interest rates, are way up here, a third standard deviation range, that there's a reversion to the mean. The reason why reversion to the mean is a phrase is because it happens over and over and over and over again. Reversion to the mean. Now, I don't know if there's a permanent structural support at this level. I think that this is more likely resistance that just happened to be temporarily broken on monetary stimulus. I believe somewhere in this box is where we're headed. And I think there's a pretty strong chance that the stock market is going to be disappointed with the bill that comes out of Congress because the Republicans want a bill that's like 75% lower than what the Democrats want. The Democrats were asking for over $3 trillion to bail out states and cities and hospital systems and pay extra unemployment and give people $1,200 again. The Republicans in Congress, which Mitch McConnell cannot seem to round up, it's like angry wild cats in the Republican Congress. There's Republicans that only want to do $500 billion and give virtually nothing to the states and cities and hospital systems that have all suffered. I would suggest that if that's what happens, you're going to see massive cuts in services, and you'll see hospital systems go bankrupt quickly within 3 to 6 months after, in the fourth quarter or the first quarter of next year. So it's pretty important that the compromise that the Democrats offered at like $2.2 trillion, $2.3 trillion, that's probably what we have to have to support the stock market, keep cities and states from laying people off, right? And that'll be horrible for the stock market. Why? Because those people pull their 403Bs out, right? They have to start living on them ahead of time. So just like the stay-at-home economy pulled forward a lot of tech earnings and helped cause this, right? If distributions from people's retirement plans are pulled forward because we don't support them through unemployment programs or another round of PPP or aid to the cities and states, you could see an awful lot of people pull their money out of the stock market. And at the margins, the retail investor has been driving this rally with Fed liquidity. Why? Retail investors had been about 10 to 12% of the stock market prior to this year and last year. Millennials started discovering the stock market in the last couple of years and really started discovering it this year. And now the retail side of the stock market is somewhere in that 22, 23% range. I mean, the retail side is now almost a quarter, for sure a fifth, hard to measure exactly, but essentially has doubled. So that's the margin. And if you've ever been in business, you know that at the margin is where you make the money that drops to the bottom line. So what happens if the boomers, who control something like a zillion times more money than the millennials, start to pull out 5 or 10 years earlier than they wanted to? That'll be a big hit on the stock market. So to dismiss the idea that we can head back down to 2016 levels, I think is pretty naive. Interestingly, on the Nasdaq, and picking time frames is extremely important when you look at charts. If you ever looked at a chart somebody shows you and they only show you like 2.5 years or some weird length of time, and they don't show you what was behind that, usually because they don't want you to see it. So I want you to take a look at this going all the way back to 2000, when the Nasdaq 100 started. Had the spike, a crash, took all the way to this time frame for the Nasdaq to get back to where it was. Now, I believe that the Nasdaq 100 are the new blue chips. I've been saying that for years. So I'm okay with Nasdaq outperforming the S&P 500. Nasdaq 100 QQQ is a narrower index, only 100 companies. And as we talked about last year, right? I'll remind you of something we talked about last year. The companies in the Nasdaq 100 account for 70% of the cash on corporate balance sheets in America. S&P 500, 500 companies. So those other 400 companies, because virtually everything on Nasdaq 100 is in the S&P 500. There are maybe 10 companies that aren't. 10, 15. Why don't these S&P 500 companies have cash? Why are they net in debt, many of them? Why do I say there's 100 to 150 zombie companies that are going to disappear in the next 5 to 10 years. It's because they have no organic growth. They're fighting the major trends. You've got all the fossil fuel companies, all the fossil fuel related companies, all the companies that are tied to the internal combustion engine, which is going to be produced much less after 2025 when the law changes on mileage requirements. So, and that's straight out of the, we talked about that when I was at CES. I was telling you what the corporate executives were telling us, right? This is something I speculate on. This is corporate executives from automobile companies and auto parts suppliers telling you the world's changing. So then we get COVID on top of it, which was just starting to get into the public consciousness in January. And it creates a situation where the service sector, which is about 20%, and I say service, I'm talking about leisure hospitality, about 20% of the jobs in America. Not super high paying jobs, but they're jobs that help people make ends meet. And those jobs have just gotten decimated. And today we get some unemployment numbers, and people are just going to say, oh, look, unemployment went down to 8.4%. Again, to use a farmer term, bullshit. I told you 3 years ago that the EIA, which answers to President Trump, has been fudging their numbers. And we found out later on that that was true. And they've been hiding the Strategic Petroleum Reserve numbers, which we'll end up getting if there's a new president, but also other inventory numbers. And when you separated out the PAD numbers, PADD, the PAD numbers on oil, you found out that that didn't add up to what the EIA was telling us. And I'm going to tell you this right now, and you'll see the articles getting written over the weekend and into next week about how these unemployment numbers today are fuzzy math. We know that there's somewhere between 24 and 27 million people getting some sort of unemployment benefit. It's a huge number. But because of the way they count things, the entrepreneurs who are eligible for unemployment benefits may not show up as actually unemployed. And what we're finding out is that certain jobs, like the census workers, 238,000 of them, are getting counted in this survey. They're out of work September 30th. Maybe they get a 1-month extension, but usually that doesn't happen. Could happen this year. So if you take out those 238,000 people working temporarily on the census, all of a sudden you have an unemployment number back up towards 10%. And then we see the companies have been telling us since June, which is when I started telling you, that they're going to be laying off all sorts of people when the PPP, Payroll Protection Program, allowed them to, right? They had to keep on, they had to employ people temporarily to have those loans turn into grants from the federal government. So what these companies are doing is they took the federal handout, they took it, while their executives didn't take a pay cut for the most part. And now they're going to lay people off. Millions of them. Starting October 1st. How do we know? Because they're telling us. You can choose to not read the information that's out there. You can choose not to believe it. But the reality is that there's major layoffs coming. Jeffrey Gundlach told us. Remember what I told you back in January at CES. The biggest risk out there for employment isn't the low-wage person. It's the middle to higher middle income person who maybe has an MBA even. And their jobs, their middle management jobs, are going to get hit because machine learning and artificial intelligence can do what a lot of people were paid to do, which is shuffle paper and check T's and cross, dot I's. There's a lot of jobs out there that suddenly an artificial intelligence programmed to do what 10 MBAs were doing can knock it down to maybe 3 MBAs and an AI. I've told you how I use AI for scanning for news, scanning for keywords, scanning for ideas, scanning for sentiment even. AIs are going to take a lot of white-collar jobs out, and COVID-19 is the excuse to do it. So it was going to trickle for years And now it's going to come en masse. And what happens when the 100,000 plus crowd, the 100,000-ish a year crowd, your $70,000, $80,000 a year jobs up to $250,000, $300,000, $400,000 jobs, depending on where you are in the country, New York, California, wherever, where the pay and the cost of living is higher. What happens when these middle income people lose their jobs? But they're accustomed to a lifestyle, right? They're accustomed to a lifestyle that requires a certain amount of income. The CARES Act says they can take $100,000 out of their retirement plan and have 5 years to pay it back with no interest. I suspect you see an awful lot of people taking basically a year's worth of expenses out of their retirement plans because they know that a lot of these job losses are permanent. Rebuilding the economy is going to happen, but it's not going to happen overnight. The V-shape we already know has leveled off. So we got the bounce off the bottom, and we're on the first ledge. And it's like a mountain pass. It's bumpy and it's rocky. And you go up a little and then you go down. And you slip in the gravel. And that's the way it's going to be for a while, until there's a vaccine. And while we're probably going to get an emergency use vaccine sometime this year, we're not going to get a mass distribution vaccine until sometime next year. Probably around the middle of the year. Last week I said, I think the first day of school next week, everybody who hasn't had a shot already, which will be most people, they're going to be able to go to schools next year. If they haven't already gone to Walgreens, CVS, their doctor, Costco, or Walmart. Any kid who's not vaccinated next year, on the first day of school, they're going to say, okay, go to the nurse's office or go to the gymnasium where they're going to have all the kids lined up 6 feet apart with masks on. Say, here's your first shot. And if it's Merck with a traditional vaccine, which is what I'm thinking it's going to be, it'll only be one shot. Maybe you need a booster. Maybe you need a booster every year. I don't know. Not sure how the technology is going to play out. I suspect that it's going, from everything I've read, it looks like it's going to be a shot a year, just like with the flu. So every year you're probably going to have to get a COVID shot to cover minor mutations and weakening of the vaccine. We'll see. But the bottom line is that rebuilding the economy with companies cleaning out all these jobs, there's a few things you need to think about. In the short term, the very short term, I say through the end of the year, you have to figure out at what point in this box do you want to buy. And I would point out that this bear market from 2000 to 2002 was actually about two and a half years, could play out here. I don't think that it will because of all the monetary factors, but there's a possibility that we get an extended bear market. I think it's going to end up being just a lot of volatility. We'll see. But this, under the Obama administration, if Biden wins, I think that's what we expect. So wherever the bottom ends up being, by early next year, you start to see things get better. You know what I think happens if Trump wins. I think we can head down here into the Armageddon zone, and we stay there for a few years. And ultimately, the Republicans realize how bad Trump is for them, and they turn on him. And then we see what happens. I don't think Trump's going to win, you know that, but we'll see. We will know sometime in November. I don't know when in November we're going to know, but we'll know in November. So I think that risk management, not worrying about missing, especially this half of the rebound, is just not that important. Because the odds of it not coming back to this level, that was resistance. It was resistance, and it went through on the Fed bailing out the repo markets. And then it went through again on the Fed blasting, not even a bazooka, but like a howitzer, right? Tanks. So when we get back to this area, right around 300-ish, 290-ish on the S&P 500, you're going to have to take a look at your risk tolerance. This might happen before or after the election, I don't know. But you're going to have to identify what you think the future holds. All I can tell you is what I think the future holds. The Biden scenario and the Trump scenario. I explained that last week what I thought. So this is the second wave zone, which we're about to enter. We talked about how the deaths are stubbornly high, the reproduction rate, and everything else is kind of in neutral territory, but certain spots of the country are getting worse. Do we think that the small investor feels great today? So we need to keep track of this, and when these numbers flip, we need to be ready to invest. And again, we don't know when these numbers are going to flip. They're coming down now. These are last week's statistics. So we want to keep an eye on when most of the people are pessimistic. Because why? When do we know that the bull market is over? When everybody thinks it's a bull market, which I said happened in the last several weeks, right? Oh, I have it here. I talked about a couple weeks ago, risk off will come fast when it comes. The stock market, the Nasdaq's down, what, 9% now in 2 days? Okay. So understanding the structural nature of the market, where the support for the buying of stocks comes from, is very important. So when we start to see all of these folks losing their jobs here in the next month or so, that's going to be another major hit to unemployment, because these are going to be permanent job losses, with the exception of, I think, the airlines rebuild over 2 or 3 years. And that'll be a great place, hopefully, for a lot of these military pilots to move to, which is traditionally what happens. Hopefully there's no war. So as unemployment goes back up, which it will, the Fed's saying 9.3% for the end of the year. And I think that's probably, I guess, fair. I don't know if it'll be a little higher, a little lower, but we know that the next round of layoffs are basically permanent, right? These are companies becoming leaner and meaner. Well, meaner first and then leaner. So, no, I haven't been looking at $3,000 suits. I haven't worn a suit since the last funeral. We just have to be aware of how this is going to play out, and we have to envision how fast it'll take, or how fast it can happen, right? That companies can rebuild. But a lot of these corporations, especially in Nasdaq, I mean, Salesforce just got added to the S&P 500, or excuse me, the Dow Jones, and then they laid off 1,000 people. What the heck? They laid off 6% of their workforce as soon as they got added to the Dow Jones. It's Salesforce. Why do they have to cut? Seriously, why did they need to cut? Because they could. This is an opportunity for them to do more automation, more machine learning, more AI. So we need to be very, very cautious, because as things went up, everybody looked at this and said, Kirk is nuts. But last year, when things were going up and up and up and up, and I said, sell damn near everything, right? I told you to sell damn near everything here. And I had a couple of weeks ago, right? What did I tell people a couple of weeks ago? Sell almost everything again, because I need to put a thumbnail on that one and that one. And what we're going to want to do is we're going to want to use that barbell investing for the 2020s, right? We want to use this and build this sometime between now and when the downward momentum stops, because the downward momentum just beginning, and we might get a rebound on next Wednesday or something. But my guess is that kids are getting margin calls right now. The kids are getting their margin calls right now. And remember what happened last year. Actually, last year, man, it's March, just March. When the margin calls came, gold got beat up. And people who don't understand gold, why it got beat up. I mean, there was one prominent author on Seeking Alpha, kind of ebbs and flows with the waves, was saying that GDX and gold ETF, I think he was referring to gold ETF, was broken. And this is more my ETF universe and holdings. I don't own all of these, right? Said that GDX was broken. It wasn't broken. It was a valuable asset that people redeemed to pay off their margin calls. Because if your calls go to zero, that's one thing. But if you're on margin, you can take unlimited losses. One kid trader shot himself for being down $70,000. We're going to have more stories like that. And it's horrible. People, in my opinion, should have much stricter margin limits. And in fact, I almost think that margin should be restricted to accredited investors. I don't think they should allow margin for non-accredited investors. If you're not a sophisticated investor, right, if you haven't made, it to the accredited status, you shouldn't be using margin. You want to use calls and puts, that's fine. There's a limit on what you can lose. But margin for somebody making $70,000 a year with a $35,000 account, and all of a sudden they get a $70,000 loss, right? On a $35,000 account, get a $70,000 loss. It can happen, and it has a lot. It shouldn't be allowed. In any case, this is an important one for us, right? Because this is a big holding for us. Remember when I told you to sell covered calls on GDX because there'd be volatility? So I said sell long-dated covered calls out to autumn. There's a lot of people with covered calls at about that 35, anywhere in the 30s. And these prices are coming down quickly. Combination of the falling price of GDX, but the time value is disappearing. So you have two things working for you if you sold these covered calls, which probably, got into the money to a point where you were like, well, gee whiz, I'm not going to get everything out of GDX that I could have, right? So here you want to look for an opportunity with GDX getting beat up and the time value disappearing quickly if you sold October's, which was one of the two covered calls that I said to sell. You can buy back these covered calls, and I think it's important that we look at that chart. And I'm happy to show this to the entire public, not just the people who pay, because this is something that, I told people to start buying gold in here. 2017, 18, 19. We bought Newmont on the IPO, or the merger. Newmont has been a fantastic stock for us, right? So that was last spring, right? So let's just go back 1 year, probably a little bit longer. There you go. I know, I was in there somewhere, right? So Newmont has done very well. But look, GDX has done almost as well as Newmont. So when I talk about asset allocation, it's important to know that, yeah, it's wonderful to be a great stock picker, but it's really hard to be a great stock picker. Almost everybody picks stocks wrong. You can pretty much use ETFs to avoid the risk of being wrong about a particular company. So had you bought GDX and didn't even own Newmont, you've done about just as well. By being in the right sectors, you're generally going to beat the market in the right industries. So I'm looking at potentially bringing on somebody who would help me build the publishing side of the company. And, he's got a lot of his money in index funds. And I said, you can't really be a bogglehead and work with me, because being spread across the big indexes doesn't make a lot of sense. I just showed you a minute ago how for 13, 14 years, depending on the index you picked, you made no money other than the dividend throw off. And in fact, that's true. During the 2000-2009 period, the average investor made about 2%. So think that through. What happens if we have a choppy decade? That means that you really need to focus on buying the corrections, and when these charts go parabolic, selling them, and being in the right sectors. So let's take a look at some of the funds. That's wrong. That we talked about. ARK was one of the funds I talked about way before it was cool to be an ARK, right? And TAN. So here's the S&P 500 over the last year plus. And these were my top recommendations. My only problem was hedging over the summer. Had we not written the covered calls, had we not hedged for risk, we would have blown it out. But now these are coming back. And the question you should ask, right? This is the group that we picked out. This is the broad S&P 500. You can see that asset allocation, and we'll even get rid of Newmont, that these 4 funds that we picked out crushed the S&P 500. Research has shown from Zacks, from Stanford, from Harvard. You pick the research you want to read. Just by getting mostly right about the best parts of the economy and the secular trends, you don't have to do this cyclically. You don't have to do the short-term trades. Just be on the side of the big trades, right? Just be on the side of the big trades. You'll make more money than the S&P 500, and you'll do it with less risk. Volatility might be higher. Risk and volatility aren't exactly the same. So as these come back down, we're going to want to figure out where to buy each one. So with GDX, right, it's the middle 30s. It's probably where you can start to nibble and close your covered calls. If it gets back down to this level, and again, this is a freebie for the public. Let me pull this over a little bit. There you go. This is the super buy zone, I think. I don't think I'd do anything right at the top. I mean, that very top level, I'd probably just close covered calls, which we're getting close to. I think it could happen on Tuesday. Why? Because of the margin calls that people are going to get on Friday. Okay? So we might be in this box by Tuesday. So I'm giving you the heads up right now. If you are comfortable selling cash secured puts, you still sell the puts when the price actually gets in here. But you may want to sell a put with a higher strike price. You'll get more premium. I think that you can go all the way to January, maybe even further out, to get more time value on your trade. I'd still buy a little bit of the shares in here as well. And I think that, again, in the lower 30s, I think you got to back up the truck on GDX. So unless we see just massive margin calls that push it way down here, and again, this is where I bought it on air with Forex Analytics. And we bought it during its lowest hour. It was pretty good. So I don't know if the margin calls push it through this zone, but in the low 30s, resistance should become support. Unless, right, unless we're headed into a more Armageddon-like scenario and it pushes all the way back down here. I don't think it ever gets below 24-ish again. I think that this is probably unlikely because these companies are making a boatload of money on the higher gold price. So we have to figure out where to buy. Now, I sent out a note this week that I'd probably even out my gold position, which was super heavy in the gold stocks, but not very heavy in gold. And we bought gold at like 165, right about here, because it looked like it was going to break out to me. And I think I told you right here to buy it. Right, 166, 167, is that what most of you got it at? And it came up, and I sold some covered calls, some cash secured puts here. It's jitterbugging. I'm okay if those cash secured puts get put to me because my net cost would be like 171, which is the top of this buy zone. So if I get those shares put to me in January, I'm cool with that. But I got a lot of time value for selling those puts. I think you could probably, if you have no GLD position, you could probably sell puts. I sold 180s, giving me a net cost right here because I wanted to add gold. And the reason why I'm adding gold versus gold stocks is because I don't know exactly, and anybody who tells you they know exactly is lying to you. I don't know exactly where we are in what would be a traditional historical cycle where the gold stocks lead and then at the end there's a spike in the price of gold, generally marking the end of both bull markets. I don't know if this is going to be a 5-year rally in gold or another year. If we take a look way back here, I first bought gold in like 2000, so it's not even on this chart. I guess we could just spot price. Yeah, let's do that one. Oh, we only went that far. Whatever. I have a save somewhere. I'm still not that good at TradingView. Every time I learn something, I have to realize I have to learn more. In any case, you can see that from 2000 to 2012 was a pretty long bull market, right? And on Market Watch, right, these clippings are out there. On Market Watch, I told people to sell gold up here. And they told me I was out of my mind. And decade-long bear market. Well, maybe not decades, 7 or 8 years. But this seems like a pretty legitimate breakout to me. So I do think we make a run at this. We're going to see a $3,000 gold price. How long does it take to get there? My guess is right in here, 2023, 2024. And then it starts heading down. Because by then the economy will be pretty repaired. It should be. If Biden wins, it'll be pretty repaired. If Trump wins, maybe we go up here on gold. Maybe we go to 5,000. We'll see. But I'm evening out my gold to gold stock position over time, over the next, I'd say, 3 to 6 months. And one of the reasons is that it is getting harder and harder to produce gold, and the cost of production is slowly drifting up. So you have to think in your mind, you have to visualize where the production costs and the sales costs, right, the sales prices, the price of gold, where you start to get diminishing marginal returns. And we're not there yet, but it's hard to figure out exactly where we're at. So another investment, and I've told folks that you buy this late in the cycle, the junior miners. And the junior miners haven't quite held up. So your price of gold has lagged, and the junior miners, I guess maybe they have actually taken off here lately. So in the last several months, the juniors, well, now they're right on top of each other. Again, it depends on what time frame you look at, right? So in that time frame, the juniors are up there. The big guys are up there, but just a little. And I've told you that they generally move pretty much in tandem. But what you're trying to do late in a cycle is figure out if the juniors are going to rise on some speculation. So here you see they caught up suddenly, recently. It's very recent that the juniors have caught up. So I'm probably going to add some junior exposure. You guys know the stock that I liked on that, and then that company had a problem. And then it went up anyway on speculation. If you follow me, you know who I'm talking about. Silvertip. And I'd rather pick out individual stocks for the juniors than use the ETF. So within, let's just do this. Oh, killing me, guys. Right? That's why I don't focus on regurgitating what everybody else talks about. Good grief. Here, I subscribe to this. So within GDXJ, what I want to do is I want to look for the 2 or 3 or 4 of these, or 5 of these. And rather than buying GDXJ for, say, 4 or 5% of my asset allocation, I think I'd rather have 4 or 5 of these stocks at 1% each. Which means we have to do the legwork, which means I have to do the legwork. So if anybody's been paying real close attention to these, we should check them out. Because as the speculators pump money into the ETF, it'll push certain of these stocks up. Generally the ones near the top, quite a bit. So it's this top holdings list that I'm most interested in. And people say, well, why don't you look lower on the list? It's because these are market cap weighted indexes. So the ones at the top of the list get more investor money and they shoot up higher, just like Nasdaq and S&P 500. So a third of these companies I'm going to end up being interested in as a basket of holdings. Now you can use GDXJ if you want, right? Because it'll probably be a little safer than picking out 5 stocks. But 5 stocks, that's a pretty good cross section. You notice that my company's not even on this list. Makes me think, should it be? Will it be? I know that they're interesting. I don't know. I know they're interesting. I know they're interesting. So maybe buying a basket of Yamana, Kinross, Goldfields, and a couple others would be the way to go. if you're inclined to pick out stocks. Otherwise, as we get later in the cycle and people start to speculate again, these junior gold miners could do pretty well. But again, with high unemployment, when does speculation come back? Probably going to be a while. So just going to answer a couple of questions. There's an article about Simon Property. And remember, last year, we talked about Simon Property. And here's what I said last year. So last June, I said, I'm concerned about the capital it'll take to redevelop so many properties for Simon. Because at the time, we knew that the malls were all challenged. Okay? I said I'd have to get a bottom fishing price on this one, which I believe I set at 46. I have to look at an old spreadsheet. And that's about what it got down to. But with COVID, I think it makes it worse. The net asset value versus the debt of Simon are about equal. What does that mean? Well, think about it like a mortgage. If your house is worth $400,000, but your mortgage is worth $400,000, what's really the value of that you hold there? It's zero. So Simon's got a problem because they're not collecting a lot of rents. And a lot of the rents that they are collecting, they negotiated down. So they have higher vacancy and lower rent rates. And everybody who hasn't renegotiated their rent rate is doing it right now. Simon talked about that. Here's the thing. It's good real estate. So at some point, Simon Properties is going to become a buy. I believe that this guy is right. I've mentioned it before. I think that Simon Property is going to dilute. I'm not sure the form that it takes. Do they take on another private equity partner in exchange for equity? You know, maybe they sell, $5 billion of shares to a private equity firm, which ends up diluting folks that own Simon. So right now, and $5 billion is the short side of what they need. Market cap's $23 billion. I think they probably need somewhere between $5 and $15 billion to redevelop all their properties. I've looked at the company, and I'm looking at actually buying them all. Right? I'm thinking about putting together a partnership to do that. I think I found one that's unique and is going to be in a gentrifying area on a body of water. Right? It's rare that you find those. With Simon, I've been to their properties in, 11 states or something, and they all need to be redone. Even the ones that were redone recently need to be redone again because the nature of the mall is going to change. And again, I think that they partially become, in some places, business campuses, where the JCPenney and the Sears and the Macy's and the Nordstrom that all went out end up becoming 4 companies at opposite ends of the mall. And then you have your business services and other things within the mall, including a bunch of restaurants. And I think, and then maybe you have condos or apartments built around the edges of the parking lots that are empty. That's a lot of money. And I do think that Simon is going to have to raise money. I just don't think there's any way around that. They have nothing really to mortgage anymore. So they'll sell off a few properties, and they'll have to make the quantitative decision of which property do they sell, how much equity do they issue, do they try to do a debt for equity swap? I don't know which debt holders would be willing to do that. But to me, Simon probably isn't a buy until it's in the 20s or 30s. So another 50 to 60 or 70% drop. And I would advise you of an old phrase that I'm going to mess up, that what's the difference between a stock that is down 50% and a stock that's down 90%, right? It's a stock that is down 50% that loses 50% again, something like that. Those numbers don't make sense, but that's basically the point. Is that a stock that's down 60 or 70%, which is what this one is, it can go down 60 or 70% again. And I think that's probably the case for Simon. Now, I don't think they go out of business. I don't think they're in that dire straits. They're just running into a spot where they need a lot of money to make this real estate better. So they're going to get that money somehow. It's going to dilute the equity shareholders. And when that happens, right, they already cut their interest rate. They might cut it again. Somewhere down in here is where that price will be. If you take a look at the chart, again, I'm covering this one because a lot of people have asked about it. All right, which support line is that? All right, there you go. There's your one from when it bottomed in 2009. It's not inconceivable that they round trip down to in the 20s somewhere. This is an important line too because it stopped going down in the 40s. So I maybe would sell cash secured puts depending on what's going on at the time if it gets back into the middle 40s. But I have to know what's going on at the time. And as I said last week, I think that a better investment in real estate is anybody who doesn't own a second home, buy a second home. Buy a vacation property that you can Airbnb. Buy a retirement home that maybe right now is a vacation property that you Airbnb, right? Or you rent it out long term. Probably make more money renting it out long term with less hassle. But I think the number one real estate investment, far above REITs, is to have a second property. And I've been pounding. I mean, you know I don't pound on things very often. If you can buy a second property, buy a second property. There's going to be properties for sale from boomers who have to have the income. They need the money. So this is a chance the market's going to give you. You find what you like, what business model that you can absorb, because the second home is part of a business decision. It's not just, oh, I want to retire there. Well, between now and then, you got to, try to pay those bills. Whether it's Airbnb or a long-term renter, or maybe you can just carry the weight yourself, whatever. For me, I'm looking at some redevelopment opportunities, and most of them are bad. Cash sucks, but every now and then you find a good one. And then I think second homes are brilliant ideas for most people. So keep that in mind. If you're sitting on $50,000, $60,000, $70,000, $80,000 in the bank, and somebody I talked to this week is, and I didn't ask for that money, but I forgot to mention this, you should be looking at a second home with that money. All right, any questions that we can buzz through real fast? Somebody says, like, right now or wait a few months. Are you talking about real estate? Every real estate market is different locally, right? So there's probably good deals out there right now. I think that over the winter, you're going to have some really good deals. So, there's usually kind of a dry spot in real estate sales right at the end of the year, right around New Year's. So, just keep your eye on the market. Start looking at 2 or 3 places where you'd really like to maybe get a second property and just get to know those markets inside and out, right? Go there, drive around, see what's looking like it's improving, what's looking like it's getting worse. And once again, I just recommend, I think that Great Lakes real estate, and when I say Great Lakes real estate, I specifically mean areas that are in the Great Lakes watershed that have rights to Great Lakes water. I think those could be fantastic properties over the next 100 years. Climate change is real. We did it, and it's going to take a century to fix it. Any other questions? So, 2 questions. One is about Kinder Morgan. Kinder Morgan's in the buy zone. If Warren Buffett buying natural gas pipelines doesn't scream out to you that you should be finding a way to buy this stock, then I don't know if anything that I could say will make it better. Somebody asked about Maxion, which just got spun off from SunPower, which is one of our stocks. Right? I mean, so far, there you go. Ooh. Look at that. All over the place. I still don't have a good idea of what Maxion's worth. So we got to figure that out. But in general, I think that Maxion, it's going to end up being in tan, I think. If it's not, then we have to buy it on its own. Let's see if this chops sideways for a while, right? That's always a good sign. Is when something chops sideways for a while, then maybe right ahead of the next earnings you buy it. Maybe. It's not on the VSL right now because the part of the business from SunPower that I really wanted is the part that's SunPower, right? I think it's going to be one of the 4 or 5 really big solar players in commercial and then eventually residential new construction. And, Total and Ford have a relationship. Just throwing that out there. Never know. Maybe those Ford salesmen end up selling SunPower too. Somebody asked why I started sniffing around Walgreens. Because how low can it go? Right? It's been chopping along in this range. They own great real estate. They have a share of their own REIT, I believe it is. Walgreens just is a great franchise. More and more people are going to be taking drugs in the future, and their vaccination services are a big deal. I mean, what if people now have to get a flu shot, which a lot of people didn't get, right? But now there's a COVID shot. Between Costco and Walmart and CVS and Walgreens, right? A lot of people are going to go there to get their shots. A lot of people. So I just think that Walgreens is probably near the bottom of its value range. And I think that it's probably a pretty good rebound stock. Now, is it for everybody? No. It pays a dividend. So for the patient dividend investor, this is something to look at. Because you might get a pop in the stock price too. So I think it's basically close to bottom. Look, it's at a 0 level, close to a 1 level. There's not a lot of downside left in Walgreens. A couple bucks. But what if it starts turning around? And you're collecting that dividend as it goes. Okay? But is it for the growth investor? Nah. Is it for the turnaround investor? Well, if you're a turnaround investor, that means that you read every single page of a company's corporate report every quarter. Can't be a turnaround investor if you don't do that. I've read everything on Walgreens for the most part. I think it's near the bottom of its range. I've been waiting years. I told people to sell it back here, and people said I was nuts. But the boomers are going to retire and need more drugs. Yeah. And now you have private equity companies looking at it. If private equity companies are looking at it, they see value. I see the same thing. And if it jumps from 30-something to 60-something, it gets to here, which seems to be a support resistance area, I'd probably sell. Because, you make 50% of your money in a year or two. It's a pretty good deal. Somebody just wants to talk about the chart. Well, you're not looking at the chart the right way then. Yeah, this is the shit. But now look, chopping along. Got very little left to go down. A few bucks. From 90 to 40 was the big drop. You buy it in the 30s. I think you're probably doing a pretty good thing. There's value here. Private equity, those guys are vulture investors. Vultures see value here. I do too, and I think that they might even start to grow again because they don't have a lot of capex they need to do anymore. They just got to find a way to get people into those stores a little bit more. I don't think that would be too hard. Maybe they do, maybe they shift a little bit more to the healthcare. Maybe they shift a little bit more to cosmetics. I don't know. But I'm sure they know what their most profitable lines of business are. And they'll focus in that direction. I think if the government allows it, they might even, start doing drug delivery, pharmaceutical drugs. Get your head out of the gutter, all you 420 people. Somebody wants to take a look at Apple. So we have to put in a new bottom fishing price, huh? So the bottom fishing price for Apple was $220 or $230. And a handful of people got it. Where do you think? Okay, so you're looking at this chart too. Where do you think the bottom fishing price is? Oops. Just looking at the structure of the chart, where do you think the bottom fishing price is roughly going to be? 60. I think you're about right. All you have to do is look at the structure of some of these charts. So let's take this low point here, go to that high point. We'll use that as our base. And really, we could go way back here, but at this point, what difference does it make, right? I mean, we could use this one as your long one. We could do super long one. It's all about picking out time frames. and being right about which time frame matters the most. Oops. I'm going to go here. To me, this is what matters the most. This rally here, how much of that was real? I'd say most of it, not all of it. Kind of funny, look at that. So when you use this long time frame, then you use your extension here from low to that high, the correction is right there at that fib level. It's weird that it happens like that all the time. So you got to play with different lines. This is what most people would do. Okay? That is what most people would do. I'm going to take it and go asymmetric. So my extension and my retrace lines are different, using different time frames for each one. I think that gives you a pretty complete look at what the range is on Apple for now. So I think you should expect Apple to eventually push this number. I think we can rule out Apple going down to 0. There's a 0.5 line right there. Right, look at where that is. 618 line, a 5. I mean, I'd have a hard time not buying it right around $80. So all those lines just kind of meet with each other. I really want that 2.6 line to be on there. There you go. Okay. So yeah, right around $90. I think under 100. If Apple gets under 100, I just have a hard time quibbling about it. Could it get all the way down here again? Theoretically, but here's why I don't think it will. Their new phone is a 5G phone, and I think they're going to sell a ton of it. But wait, there's more. I have a stock. Going to put it on the plug and play, I believe. I'm going to replace Dynavax because I think Dynavax is too speculative. But I have a small cap stock, mid cap stock, that makes a part for all these iPhones, and I think that their orders are getting increased right now, and I think that stock will probably go up triple or quadruple whatever Apple goes up. And it'll be a trade, it'll be a 6-month to a couple year trade, but it's probably going to do real well. So I'll be giving that stock to all the subscribers here in the next couple of weeks. But I do think there's a much better way to play Apple than Apple. So, yeah, there you go. Anywhere under 100, I think you probably can buy it. You could bounce this all the way up to that line. See? Get a little jitterbugging right there. 786s aren't the best lines, but they're lines. Pretty darn strong support in here for sure. All right. Somebody puts Ford and Total with a question mark. So what the heck does that mean? What do you think it means? What company does Total back? SunPower. Okay. And Total and Ford have a pretty strong relationship. Have for a long time. GM, Ford, they all have relationships with the big oil companies. They used to cross-invest. I don't know if Ford and Total did, but consider this. Total is majority owner of SunPower. They're going to want more exposure, more distribution. I was at a Tesla dealership yesterday. I went to the Tesla dealership in Milwaukee that just got opened a few months ago, and it is run by the I can actually tell you because I have it in my phone. It's run by a car dealership out in Chicago, Highland Park, Illinois. And we went there to test drive a Tesla Model Y or X. I actually had put X down because I thought I was selling my 4Runner and I wanted a bigger car. The problem with the X is it's still, I just can't justify buying a car for that expensive, even though it's super cool and it's big. So we were going to end up looking at the Y. I've already seen the Mustang Mach-E. I think the two cars are on par, but I want to know for sure. Got there, front door is locked. Go around to the service entrance. Guy goes, "Why are you here?" I said, "We have a test drive." He goes, "Call this number, go outside, they'll unlock the car for you." That's it. That's exactly how we did it. So we go outside, we call the number, we hit the extension, we try 5 or 6 different times. Phone rings for 25 minutes over the course of 4 or 5 phone calls. We leave without test driving the Tesla. That wouldn't have happened at Ford. At Ford, they would have put me in a car. So I will posit to you this. I'm the same guy who owned Tesla under 100. I'm the same guy who told you twice to buy it when it dipped under 200. And then I sold it in the low 400s because I'm dumb, right? I doubled my money on Tesla 3 different times, but I'm dumb. I'm going to tell you this about Tesla. I've been looking more and more at their earnings and their cash flows. And I have taken to heart some of the criticisms of the company, which for a long time were overblown. Because I told you that there's enough fanboys, rich and retail, they'll never let the company go bankrupt. But they are priced as if they're going to take over basically the entire car market and never have competition because they're going to crush everybody. It ain't true. Tesla's got major competition, and it's finally getting here. And you're going to get announcements from Ford and GM, just like you did from Volvo and Volkswagen, that the competition's coming faster than they anticipated. It's not going to be 2026 or later. It's going to be 2025 and sooner, with an awful lot of that competition hitting next year and almost all of it hitting by 2023. Are you all going to buy your car online? I think that Tesla has got some problems going forward when it comes to justifying the share price. I don't think they're going to zero. I don't think they're going out of business. I don't think that they're going to be a failure. I just think that the valuation is insane. And I think that Ford is going to be the next Tesla. I think Ford is going to make some exciting announcements between now and early next year. And I think that everything that I've told you about Ford in this week's, right? This week I covered it, right? In the stocks of the week, I covered Ford. Ford's going to make money several different ways. And by the way, they have a built-in consumer base, loyal Ford buyers, that as the shift to EVs becomes more and more apparent and acceptable to people, they're just going to go out and buy a Ford because it's cheaper than a Tesla, and it's going to be the same quality. In fact, I would tell you that the Ford quality may end up being higher than the Tesla quality. We'll see. But at $6 or $7 a share, there you go. There's a stock that you can buy right now. If you want to buy a stock right now, buy Ford. And again, I'm willing to say this in these webinars because 1,000 people watch them. At some point, hopefully these webinars are getting tens of thousands, but you know, I've been telling you about Ford for a while now. Since January, started telling you about Ford in January. Came down for us. It's going to keep going. Should use the jitterbugging to buy it. 1-2% of your portfolio for now. And as you do the reading, as you become a believer, I think you can pyramid this position. But I do think you probably get some jitterbugging in here. I mean, it could come back down into the 5s. You just buy more. I think Ford is going to be a very expensive stock in the future. And I'll clean this chart up. But I just want you to see where some of these lines go. Ford can be a 10-bagger. No sweat. I'm not saying it will. I'm just saying it could. Because if all the little kids take their Tesla profits and start putting some of it into Ford, right? When Ford announces that they're going to be the American competition to Tesla, the stock's going to roar. And you'll get your first couple of people who say Ford can't compete with Tesla. And again, I'm going to use what farmers say, bullshit. Ford has hired more AI PhDs than anybody else in the car industry. I showed you in this article the links to the fourth industrial revolution stuff. Ford is a leader in this. You need to own Ford for part of your growth side of your barbell. All right, I'll let you all go. The Hulk is in the house, so I'm going to be a grandpa for a little while, but I'm going to be in the chat rooms the last couple hours of the day because we might have some opportunities, so I just want to check in. I don't think I'm going to be making any trades today, but I think on Tuesday, if the margin calls happen that I think are going to happen, we're going to have to take a look at GDX. And do we want to start closing out some of those calls that we wrote, the covered calls? And do we want to start selling some puts? So I think over the weekend, you need to do some reading. I'm going to put out a couple articles over the weekend. Probably do one Saturday, one Sunday, one Monday. And if you don't have a good position here, or you need to close your covered calls so that you can hold on to this until it gets up here, because that's where it's going, it's going to get into the 60s. So this pullback is a way to clean up your position in GDX and make it what you want it to be. It's not getting down here again. I just can't imagine. It might get here. But this is, I think, the main area. All right. Have a good weekend. Think about all the people who've worked hard in this country and what's fair to them. Should we place labor ahead of capital? I think probably we should. And hopefully we do. But that doesn't mean the stock market will be bad. It'll just be a bit of a reset. And then it'll be more organic, and that's good for the stock pickers, and that's good for the good asset allocators. The throwing shit against the wall and making money on it, I think that era is about to end, one way or the other. I have a little music to finish the day. Peace out, folks.